All right, we are back for another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
I'm doing well, man. Thanks for having me. This week, I got to admit, I'm tired this week. This was a rough week. There was a lot of emotions going on.
What a wild ride, right? I mean, we talked about it last week. This is for Happy St. Patrick's Day, March the 17th, 2023. This has been a wild week. Let's get right into it. Silicon Valley Bank. What are your thoughts there today for this week, and just general thoughts about Silicon Valley Bank?
So Silicon Valley Bank is one of two banks that were taken over by the FDIC in a 3-day span, Friday to Sunday, Signature Bank being the other. What I find most interesting is the size. Silicon Valley Bank went down as the second largest bank failure ever after Washington Mutual. And then lo and behold, 48 hours later, Signature Bank, which I will admit to being a bank I had never heard of out of New York, fails and is now the third largest bank failure ever. I think these bank failures point to a lot of underlying problems, most of them being caused, or I shouldn't say most. Basically, what has happened over the last year is the Fed has said, we're going to raise rates until we beat inflation or break something. I think we're seeing the weakest break. Now, Silicon Valley Bank clearly had some operational challenges, some risk management challenges, some concentration challenges. They are not innocent in all of this. But a lot of their loss was because they had unrealized losses on their books, which caused them to be insolvent, which caused a bank run that turned out to be $42 billion in the span of 6 hours. Now, on my channel, that's breaking news. Most people say $42 billion in 24 hours. I've interviewed a tech CEO on my channel who got a call at 6 a.m. and the banks were locked up by 2 p.m. So it was not a 24-hour period. There was $42 billion moved out of Silicon Valley Bank in a 6-hour period. That is $2 million a second. A second.
Wow.
So we had our first digital bank run. Our bank, the only way that happens so fast is it spreads on social media and text and Twitter and all these other messaging apps. It was bad. It was fast. It was traumatic to watch. And then the aftermath in the Silicon Valley. Can I make payroll? See, the tragedy about this event, and this CEO told me about this in the videos on my channel. Shout out Dana for sharing the gory details. Payroll's the 15th, right? Payroll was Wednesday. In order for the companies to pay their employees, they have to wire the money Monday. And all of these 10,000 plus companies were worried about making payroll on the 15th. And it was very stressful. And it could have been a huge problem. So Silicon Valley Bank's not innocent by any stretch. But yeah, bank failures of that size, they don't happen. We saw our first digital bank run, and it was classic bank run behavior. I mean, just think about it. Silicon Valley Bank was nominated by Forbes as being the #1 bank. They had an A rating by Moody's. I mean, it's looking back on now a week later, it's traumatic. So crazy.
What's really interesting too, Michael, is that, today, 2023 versus say 2007, 2008, or even into the 80s in the S&L crisis, because digital, because social, and the word just travels so fast now that everything moves so quick. Like it's interesting there. I want to connect the dots. So Credit Suisse, you talked about today in the Daily Financial News. I know we're also going to talk about bailouts, and maybe we'll go into bailouts.
Sure.
Talk about Credit Suisse also. And I want to throw this out there too. First Republic, which is also very regionalized here in the Bay Area. Mm-hmm. What are your thoughts with Credit Suisse? And then even some of the murmurs and articles and whispers about First Republic, or what do you see there with regard to bailouts or other banks being pulled in here?
Yeah. So first and foremost, Credit Suisse has had a horrible decade. They have had catastrophe after catastrophe after catastrophe. I think a decade ago, they were a $70 stock and they're a $2 stock today. So they were weak, injured. However, they are still listed as one of the 30 most important banks in the world. So that is code for too big to fail. So was Credit Suisse caused by Silicon Valley Bank? Not really. They were already injured. They probably, I don't see the direct connection, but I certainly see how the average public goes Silicon Valley, Signature Bank, Credit Suisse, and they just connect the dots. I'm not sure it's a direct line, but that is somebody who looks at this every day, who has been through banking crisis before. I think Credit Suisse is its own catastrophe, in my opinion. Now let's talk about bailouts. First, we'll close on Credit Suisse. Credit Suisse suddenly, magically, $54 billion bailout from the Central Bank of Switzerland. So they're good, right? They're taken care of. Now back to the bailout for Silicon Valley Bank, Signature Bank, and arguably all deposits in the country. So I believe on Sunday evening, FDIC, Treasury, Fed, powers that be, actually established the biggest bailout in history. Most people don't see it. What I mean by that is FDIC, historically speaking, has been up to $250K. They have a perfect track record of paying back. They would have paid back this time also. And that's the kerfuffle, right? Silicon Valley Bank, by one report, said 97% of funds on hand were not insured. Hence, 97% of funds are at risk for at least a haircut, if not zero. Now, I don't think it would have ever been zero, but possible. So what happened in a very quick 48-hour period is the Fed and Treasury and FDIC came out and said, we're going to honor all deposits. All deposits are good. I believe personally that was too much. I believe I had called for as soon as Friday an 85% because it would not have been unheard of. People may not know this, but back in the day at IndyMac also was a bank run. And IndyMac that next Monday, they gave them 50 cents on the dollar because it was important to have the operational capital available. I get it. I understand it. Making payroll could not have been missed. Missing payroll would have blown up the system. Layoffs, companies. There were companies already planning to shut down Monday because all their operational capital was locked up. This could have been bad. Hence, if you give them 85 cents, they're certainly not happy. They're certainly upset, but they don't shut down. That's where I have a problem with this, is there should have been a haircut, in my opinion. Everybody and their brother knows about the FDIC limit. And the fact that you don't have treasury management or sweep accounts or something to protect most of your money, I'm just not okay with. Capitalism, I hate it. I hate it when capitalism wins and then we socialize losses. I hate that. If you make a mistake, you should lose. Now, again, I don't think these companies deserve 100% of the loss, hence give them 85 cents, and I think they would have been made whole. But yeah, I wasn't happy with the 100% bailout, but maybe I'm wrong, but I wasn't happy.
I want to reference that you did a video, I believe, on Saturday or Friday that you broke down. And I want to reference for you, the viewer,
Yeah.
If you're watching this, go back. Michael did on Daily Financial News, either Friday or Saturday. And you broke down exactly like the 250 limit on FDIC, then the 50% coupon that would have been within several days. And then the rest of the other,
Over time,
let's call it 35% over the next 30, 60, 90 days of getting settled. But you talked about that. And I thought it was a great breakdown of anticipation or expectations. So
I again, one of the things you do when you're in this is you could try to play the dominoes out. And I proposed what I hoped would happen. And I got as high as 85%.
It made a lot of sense the way you broke it down. And it's like, okay, not a total loss, but also at the same time,
they can make payroll. They can do that. They have at risk. If you had money over 250, you had at risk capital.
Sure.
Yeah. So I didn't like it, but hey, it is what it is.
Well, let's continue to move forward. So let's talk about the consumer. Also, too, you're watching this right now. You're listening. I want to encourage you, stay to the very end, because I'm going to make sure that we get Michael to connect the dots, and we're going to pull this all back to what does this mean to the one rental at a time investor?
Yep.
What does this mean to mom and pop that are even just homeowners
Yeah.
to the overall regular traditional real estate market? And or how does it also tie in with commercial real estate,
Yeah.
maybe multifamily, small commercial deals? We're going to talk about opportunity. So stay to the very end. Michael, let's continue. Consumers. What did you see this week with consumers?
I think the consumer broke over the weekend. What do I mean by that? Right. We were YOLOing, we were retail sales, we were having a good old time. I think what happened, at least what I saw in the average consumer, and these are people that don't have 250K in any bank, right? So this is just the average mom and pop. They got scared this weekend. And I've been doing this a long time. And once the consumer breaks, they conserve. The consumer will cause a recession. So what I think happened this weekend is the consumer is now scared, and a scared consumer doesn't spend. And we have now started what likely will be the start of the recession, maybe as soon as Q2, which is 2 weeks away. Because I see mom and dad being very concerned with what's going on. And, and oh, by the way, that'll help inflation come down, right? Because again, the consumer stops shopping, stuff stays on the shelves. You've seen oil's down to like $67 or something. It's down like $7 in 4 days. I think the consumer retreats. I think inflation comes down even faster than I expected because the consumer is out sooner than I thought. But yeah, I think the big news from the weekend that no one's talking about is a scared consumer is going to stop spending. That's what I think.
Just based on the bad news, based on the way
fear, uncertainty, and doubt. Fear and FUD. Fear, uncertainty, and doubt.
100%. Let's continue. So let's talk about this week. We had a big announcement. I don't think it was talked about a lot, but let's talk about CPI. What happened this week with CPI?
Shocking. CPI came out on Tuesday and almost nobody talked about it because it was still in the aftermath of SVB. But CPI came in, frankly, on the screws as expected. It was expected to come in at 6%. That is down from 6.4. It was expected to come in month on month at 4. It came in at 0.4. So all the numbers were good. There was one number that was hot. Month on month core came in at 0.5 versus 0.4. But lo and behold, CPI is showing inflation coming down. I dug in for 24 hours and actually found out that CPI is even better than that. About 70% of the 6% is housing related. And if you've been paying attention to my talk about housing will roll over. Yep. It just takes time. It'll roll over in the summer. So, I talked about going from 9 to 6 relatively quickly. We're already there. I think 6 to 4 is all housing. And then we worry about wages and services later. So I think inflation is on the downward trend. And the last thing is I called this month, which will be interesting, to be peak housing. And it came in at 8.1. So I'm hoping it's better, I guess you would say, next month, which will be under 8. But it's like a roller coaster. The way they calculate housing and owner's equivalent, it's 12 months and every cart is a month. We just have to get over and crest, and then we're going to have 6 months of downward trajectory. I'm hoping we're at the peak, like the first cars here. Maybe it's not quite there, but the next month or two, it'll start rolling over.
I love it. I love it. This is good. I feel like it's so refreshing that everything you've been talking about, you've been illustrating, you've been explaining to the one rental at a time community, it's all coming to fruition. So let's talk about PPI. What happened with PPI? What is it? PPI. What is it and what happened?
So PPI is Producer Price Index is the acronym. You could think of it as wholesalers. So you go to a store and buy something, that's CPI. But the store buys something, that's PPI, simply said, or an easy example. PPI was perhaps the best news of the week. PPI was expected to come in, I think, at 5.4, and it came in at 4.5 or 4.6. It was a huge miss to the downside. The reason that is important is because PPI is a leading indicator to CPI. So we had CPI come down, and now the leading indicator came down, and it came down by more than expected. On top of that, the month-on-month expectation was supposed to be up 0.3. It was negative 0.1. So it is deflationary. So a lot of good signs inside PPI. PPI, by all accounts, if you want inflation to come down, PPI was your number of the week. It's only one number, and we don't get excited by one number. But if you were to get excited, that's the number to be excited about.
Very good. Good to know. You've been talking about it and everything is moving along. So let's talk about retail sales. What happened this week?
Retail sales, one of my experts on Monday, Taylor, calls it the drunken sailor report. And I'm like, the drunken sailor report. It's basically because consumers went out in January and spent like drunken sailors, right? Retail sales were up 3% when they were expected to be like flat or something. Lo and behold, retail sales in February were negative. They were down. They were down, I think, 1.5%. So again, the consumer is getting conservative. And oh, by the way, that's before the banking crisis. So if the consumer was already retreating, now they have this fear, uncertainty, and doubt. I expect retail sales to be pretty rough in March.
Interesting. Okay. Well, good to keep an eye on. And again, I want to also come back to something. I would say I borrowed your line, which is good news is bad news is good news.
Mm-hmm.
And that when the news is bad, when retail sales are down, that's actually good because that means that
beating inflation.
Working.
Yeah, exactly.
Okay. So very good. So should we talk about the Fed next week or should we finish on mortgage rates or do you want to talk about rates first?
It doesn't matter. It's your show.
Fed. Let's talk about the Fed next week. And then I think we'll finish on mortgage rates. And and then also what we'll really finish with is connecting the dots. So stay with us, listen to the very end. What do you see for next week with the Fed? Jerome Powell, the Fed chairman.
So the Fed has their 2-day meeting, Tuesday, Wednesday next week. Wednesday, they come out and talk about the rate increase, which is important. I will caution you that will be where the most theater is, but the most important thing is going to be their dot plot. We'll talk about that in a minute. But the Fed meeting next week, I am 99% sure they come out with a quarter point. I've talked about a quarter point for months now. Why change? But I want to be very clear. There's a lot of people saying the Fed should pause. And I want to be very clear and on record and have receipts. If the Fed pauses, the market's going to lose their freaking mind. Because a Fed pause after all the jawing of the Fed will basically tell the market, this shit is not controlled. It is worse than you see. We are in trouble, folks. So by my account, the Fed has to raise a quarter point to not have a panic. If they don't, if they go zero, we will have a panic, in my opinion. So a quarter is a lock. The big question is, will they talk about more rates or will they say, you know what? We think we're done. That's an interesting discussion, but they have to raise a quarter, Ty. If they don't raise a quarter, I think all hell breaks loose.
Well, you've been calling a quarter for months and months.
A long time, yes.
Months and months and months. You've been talking about it. Even at one point before the banking crisis, you were still adamant that you thought they should go 50 basis points, but then in fact they would do quarter.
Correct.
So, and it's interesting because now people are talking about a pause. So at a quarter, where would that put the terminal rate?
Terminal rate would be between 4.75 and 5%. They have this range. So right there.
And I want to say again, keeping the receipts, you called for a long time terminal rate at 5, if I'm not mistaken. Is that accurate?
Yep. 4.75 to 5. Yep.
Okay. So right on point. I love it. So let's finish the show with mortgage rates. And again, opportunity. What does this mean to the one rental at a time community? What do you see with mortgage rates this week?
Yeah. So the bond market. So again, when clients or customers are fearful, they buy crypto. Some people buy crypto. Some people buy gold. Most people buy bonds. Flight to quality, flight to safety. So when people buy bonds, rates go down. So we saw the 2-year note over 5%, I think, the other day. Actually, can I get confused? So yeah, I think the 2-year note was over 5. The 10-year was over 4. They are no longer at that. The 10-year now is at 3.5. It's bouncing around. So flight to safety. That has brought mortgage rates down. Mortgage rates like last week were 7.07, I think, 7.08. Yep. They're now 6.5 or 6.55, something like that. So we've seen a 0.5 point drop in mortgage rates. What's important is on my channel, we've also documented over and over and over and over again that if rates go sub 6, all hell breaks loose in first-time homebuyer homes because there's no inventory. Just the inventory is anemic. It's a problem. So that's where we are today. I put out a note yesterday because I like looking forward. I like making calls and then being held accountable. It's just, I enjoy doing this. I enjoy being right. And when I'm wrong, I wear a shirt that says swing and a miss. I am now calling by April 15th, 2023, that rates will be sub 6% again. So in the short term, I think rates go down,
Interesting. Yep.
which again, you have rates go down into the spring selling season. I feel terrible for first-time home buyers because inventory doesn't come back until rates are under 4. And I don't see that. The
Yeah.
move-up buyers not moving. They're not incented to sell. If you have a 3% mortgage, you're not selling because you can get a 6. So I don't see good news for first-time home buyers, unfortunately. I think rates go down. I think more people are qualified. I think buyers come out, but then we have offer review dates and bidding wars and nonsense again. So I'm kind of scared for the housing market because it's so broken.
Got it. So still continued theme 2023, a broken housing market, which really means low inventory, very competitive for entry level first time buyers. Obviously with rates coming down, it's going to be, we can probably expect that market is going to be strong in terms of value, probably hold values, maybe
sure.
potential multiple offers and bid up.
You would think.
Okay.
You would think.
I want to go back to, it was a Fortune magazine article. I believe it was a Lance Lambert article. And I did a little 90-second piece on Instagram about it, but I want to go back to it because I know you know this. CoreLogic called for a 3% increase in values. One of the big four, KPMG, they had called for a decline. And so the way I summarized it was what I've learned from you, which was we're in a bifurcated market. You've got the entry level stuff. That stuff probably does go up a tick or two, whereas you have the move up and the luxury, which is still probably going to remain soft only because affordability at 6 or 7%. It doesn't matter. It's still going to be soft. What are your thoughts on just that general conversation?
No, I think you're absolutely right. I think the housing market's going to be broken all year. I think entry level is the toughest place to be. If you are an investor and flipper like you are, I am, others on my channel are, if you are touching anything above the median, you're a fool, just a flat out fool. But there's a lot of money to be made buying slumlord junk, putting real money in and creating a first time. There's a dearth of supply. So if we can go find ugly ducklings that first time home buyers can't qualify for, can't pass inspections. It is so wrecked that they don't have the repair money. But there's money to be made and a service to be provided. I just bought a house for $175. Over the course of 8 or 10 weeks, I put $50K into it. I did this with cash, no debt. And I have it listed in escrow at $299.
Love it.
I will do dozens of those if I can find them because it only makes sense below the median. And let's be clear, the market I'm in, median's 380. So I have created a move-in turnkey, beautiful property. Look at the walkthrough videos on my channel for $300,000. I'm 20% below the median. I will do that all day long. I will buy all of the piece of junk that I can. I just talked to a lender that will loan me 80 or 90% and give me the repair money on all of those I can find.
Yep.
So if you have deals in Fresno, Madera, bring them to Ty and I. We'll do them together. It doesn't matter. We want to provide first-time home buyer homes, but there's definitely, you got to buy them right. You got to buy junk. It's just junk. I mean, the one that I had a hole in the wall. The roof needed to go. The kitchen got gutted. The bath got gutted. But if I can do that, make $50,000 and get a first-time home buyer home, why not?
I love it. I love it. So real quick, we want to make the offer, talk about the buy box event. We'll make sure that there's a link in the video, in the comments. Tell them about that event. I know there's only like 47 seats left.
Yeah.
You sold 57 seats within about what, 24, 48 hours?
48 hours. So one of the things I did on my trip was I tried to figure out how I could give more, of what we do here at One Win at a Time. And one of the things I've come to realize is while the buy box is the anchor of One Win at a Time, I need to go deeper and answer questions. And I know by interacting with people, you just get more questions. So I'm putting on a session Sunday, the 26th from 8 to 10 a.m. It's only available for 100 people. I cannot increase it. My Zoom account is only 100. I am doing this as a meeting, not a webinar. That is important. Why is that important? A webinar means I just present and interact with chat. That is not what I want. I want to educate And then I want to pull up different people's buy boxes and tweak and change and answer questions. We will then hopefully have time to get out of the buy box and go to the spreadsheet and talk about how to build a spreadsheet, how to learn average, how to do daily discipline. And I want to pull up people's spreadsheets and say, I would do this. I wouldn't do that. I would do this. I wouldn't do that. So my intention is to do this as a meeting. And then finally, I am charging. When I do things and I've given plenty of stuff away, I get trolls and haters and just people that blow up the meeting. So this is going to cost $47. It just is.
Pennies.
Yeah. And you're going to get 2 hours of my time, which I don't sell my time for that low amount, but I had to do something because I'm tired of the trolls. And yeah, I've already sold 53 seats. I've talked about it twice. I fully expect this to sell out by Saturday. There'll be a link below. And if you do miss out, if you're not one of the first 100, my intention, assuming the quality is to my high standards, I will chop up the video and sell it for $47 if you miss it. If you come to the event, I will send you the video for free because you already paid to be there. But yeah, it's yeah, we're going to go deep on the buy box because now's the time to do the work. The market is slowing down. Finding deals is hard. We don't gamble, but I'm sending out deal cards every day. These cards over my shoulder, this shoulder.
I love it.
First time cards, next deal cards, man. It's fun. And a lot of it's about the buy box. So we're going to go deep on Sunday, the 26th.
Sunday, the 26th. In the comments, you can buy your tickets. I would encourage you. This is critical. And not only that, like what Michael said, you're going to actually be able to ask him questions, interact, dialogue with him in a Zoom meeting, not a webinar where you just get to the chat, but you're actually going to get to talk to him and ask very specific questions. So I want to also just real quick, any realtors in Fresno, California, we are going to be putting together a masterclass. If you are interested in learning more about creative financing, sub-2 financing, seller financing, and more important, how to adapt and shift in 2023, I'm going to be doing a free masterclass only for realtors in Fresno, California. All you got to do is email me here, ty@tylg.com, ty@tylg.com. Michael and I, specifically Michael has injected this contribution spirit, this go-giver spirit that we want to give back in a massive way. Michael, thank you for all that you do.
Thank you, Ty.